Hey everyone, welcome to this August 14th, 2026 explainer. We find ourselves looking at a pretty fascinating paradox in the cryptocurrency markets right now. As we speak, Bitcoin is trading around $63,500, and it's hovering at a truly critical crossroads. On one hand, we are witnessing some of the heaviest institutional buying we've literally ever seen. But on the other hand, the price itself is really struggling, and fear is visibly creeping right back into the market. It's a classic tug-of-war between smart money making long-term bets and short-term price friction.
So, here is our roadmap for today. First, we'll look at the institutional undercurrent. Second, short-term surface friction. Third, hidden bottoming signals. Fourth, the macroeconomic weather. And finally, the ultimate bottom line.
All right, let's dive right into part one, the institutional undercurrent. When the price dips, it is so easy to panic. But the big money, they're telling a completely different story. $356 million. Just this week, JPMorgan disclosed that they boosted their Bitcoin ETF position to over $356 million in the second quarter. They aren't running for the exits. They are actively buying into this dip. That means their position has actually more than doubled since the first quarter. Wall Street institutions of this size do not double their exposure by accident. They're systematically using this current price weakness as a major accumulation opportunity.
And hey, it's not just JPMorgan, and it's not even just Bitcoin. Morgan Stanley is adding crypto ETF exposure. The Bank of Montreal is doing the exact same thing. JPMorgan is even jumping back into XRP ETFs after completely exiting them in the first quarter. We're not talking about retail traders chasing social media hype here. These are trillion-dollar asset managers making highly calculated, long-term bets.
Moving on to part two, short-term surface friction. So that begs the million-dollar question, doesn't it? If all this big money is aggressively buying, why on earth isn't the price moving? Well, to figure that out, we really have to dig into the underlying market psychology and the technical resistance that's capping the current price action. It all boils down to something called underwater buyers. See, right now, the $64,000 to $65,000 range happens to be the average cost basis for short-term holders. That means a massive chunk of folks who bought recently are currently underwater, meaning they're holding at a loss. Psychologically, that's pure panic for retail buyers. So when they finally see the price bounce back up to their entry point, what do? They sell, just to break even. And that creates this massive, hard ceiling of resistance that even the calculated institutional buyers are struggling to punch through right now.
If we map out these battle lines, our immediate resistance zone is sitting heavy at that 64 to 65,000 level. On the flip side, looking down, our immediate support is right below us at 63,000. If that floor caves in, traders are eyeing 60,000, followed by the June low of 58,500. And look, if some major macroeconomic shock hits out of nowhere, analysts warn we could see a deep value zone near 55,000. In the immediate short term, the bias here is undeniably bearish. Now, that $63,000 support level isn't just a random number. It represents the median realized price, which is essentially the average price at which all circulating Bitcoin last moved. It is a highly critical psychological and mathematical floor. If we break and close below it, the data suggests it could easily trigger a cascading drop straight down to that 62 or 60,000 level. Let's flip the script and look at part three, hidden bottoming signals. Because if you can just look past the surface level doom and gloom, the underlying data strongly suggests the market is actually trying to form a floor. First up, look at the whales. While it's holding more than 1,000 Bitcoin, literally the most massive, sophisticated players in the space have totally stopped selling. Even more importantly, they've actually been quietly accumulating for 3 straight weeks. This kind of heavy, silent accumulation by massive holders, that's a classic textbook signal we almost always see right near a market bottom. Second, capital flows are officially reversing. After weeks of brutal outflows, digital asset investment products just saw over $1 billion in massive, exciting inflows recently. The smart money is quite literally pouring back into the ecosystem, even if the daily price ticker hasn't quite reflected it yet. Third, we have to talk about market sentiment. The Fear and Greed Index is currently sitting at a score of 36, which puts the market firmly in fear territory. Now, I know that sounds bad, but historically speaking, extreme fear is exactly what you want to see before a major market reversal. It essentially means the weak hands are finally being shaken out. And then there's this absolute wild card. Usually, Bitcoin trades pretty much in tandem with tech stocks,
But check out this divergence. Over the past 90 days, the S&P 500 is up about 5%, while Bitcoin is down 20%. This weakening correlation with traditional equities is fascinating. It could eventually allow Bitcoin to completely decouple and start trading purely on its own fundamentals, totally free from the drag of stock market corrections. Which brings us to part 4, the macroeconomic weather.
Listen, we really can't talk about decoupling without addressing the giant elephant in the room. U.S. Treasury yields are currently sitting above 5.2%. When you combine risk-free yields above that massive threshold with a remarkably strong U.S. dollar, it creates a serious, undeniable headwind for crypto. Think about it. Why on earth would investors risk their capital in volatile crypto markets when they can literally just get a guaranteed return straight from the government?
Because of that dynamic, the entire market is basically stuck in a holding pattern, just waiting on a chronological roadmap of macro catalysts. First, the market is waiting on the U.S. Non-Farm Payrolls report hitting at the end of August. Shortly after that, we get absolutely critical CPI inflation data. And finally, all eyes are going to turn to the Federal Reserve's Jackson Hole Symposium. The market is literally holding its breath for any hint of dovishness, any signal whatsoever that rate cuts are actually finally coming. Honestly, that could be the exact spark needed to ignite a massive rally.
And finally, part 5, the ultimate bottom line.
So, how do we actually navigate these two totally opposing forces? Well, it's really a tale of two timeframes. In the short term, Bitcoin is definitely stuck in a choppy range with a slightly bearish bias. It absolutely has to break and hold above $65,000 to regain any real momentum. Traders have got to respect those levels and manage their risk. But long term, the institutional accumulation story is fully intact, folks. Whales are buying, Wall Street is doubling down, and if the macro environment shifts with rate cuts, we are primed for a truly powerful rally. Long-term investors need to recognize this current period for what it actually is. It's a bottoming process, definitely not a death spiral. Which brings us to the ultimate question as we look ahead through the rest of the year. Based on this crazy tug of war between Wall Street accumulation and these heavy macro headwinds, what is your Bitcoin price prediction for the end of 2026? Drop your thoughts, your targets, and your reasoning down in the comments below. Let's see who's actually reading the data right. Thank you so much for joining me for this explainer, and I will catch you in the next one.